Welcome, everyone. Today, we're going to walk through a question that sits at the heart of every financial conversation. How do you reduce risk and still end up with higher returns? It sounds like a trick question, but it isn't. In this session, we're going to reframe the way you think about portfolios, risk, and long-term outcomes. And by the end, you'll understand why managing risk is not something that slows you down. It's actually what allows you to reach your financial destination faster. Before we get into the real meat of our discussion, here's the usual but important disclaimer. What you're about to hear includes hypothetical performance, which always comes with limitations. Real markets behave in unpredictable ways, and no model or strategy can guarantee future results. Think of this as guidance, not gospel. The principles we discuss today are directionally sound, but the actual road always has its bumps. On this slide, I want you to imagine that your financial journey is a long road trip toward your goals. Every road you see here represents a different kind of investor path. Some roads are fast, some are slow, some are smooth, and others feel like you're driving over potholes the whole way. Let's break down what you're looking at using a simple driving analogy. First, returns. Returns are your speed. They tell you how quickly your money is growing. Faster returns mean you're moving down the highway at a higher speed. Slower returns mean your car is taking its time. Next, risk. Risk is the bumpiness of the road. A risky portfolio isn't necessarily bad. It just means the ride has more ups and downs. The bumps might make you tense up, but they're part of the road you're on. A smoother road means fewer surprises, fewer sharp turns, and fewer moments where you grip the wheel a little tighter. Now let's talk about drawdowns. Drawdowns are like hitting a ditch in the road. It's that sudden drop where the car dips down before climbing back up. Some ditches are small, some are deep. And just like driving, the deeper the ditch, the more time and effort it takes to get back up to speed. In investing, deep drawdowns slow down your journey because your portfolio must recover before it can move forward again. Finally, the Sharpe ratio. Think of the Sharpe ratio as a measure of how efficiently you're driving. It answers the question, for the speed I'm getting, how smooth is the ride? A high Sharpe ratio means good speed with fewer bumps. A low Sharpe ratio means that even if you're moving quickly, the road feels rough, unpredictable, or stressful. So when we ask, which road would you pick? We're really asking which path lets you reach your financial destination without making you so uncomfortable that you want to pull over and quit. Because the road that gets you there is the one you can actually stay on, consistently, confidently, and for the long run. On this slide, you see the journey to financial freedom laid out as a set of different lanes on a highway. Each lane represents a different investing style, but here's the important part. You are never stuck in just one lane. You can change lanes whenever your comfort level changes. On the left, the fast lane is built for speed. It's powered by growth assets like stocks, and it can move quickly. But the road is steep and the drops can be sharp. This lane works for people who can handle big swings without losing sleep. In the middle, you have the smart lane, a diversified path that blends stocks, bonds, and gold. It gives you a balance between speed and stability. Many investors find this lane comfortable because it still moves, but the bumps are more manageable. And on the right, you have the steady lane, the smooth road. It relies on safer assets like bonds. It won't get you to your destination as fast, but it gives a calmer ride with fewer surprises. Some people prefer this because consistency helps them feel secure. Now here's the key idea. Your lane choice isn't determined by your age. It's determined by the level of risk you're truly comfortable sleeping with at night. Some 30-year-olds prefer the steady lane because volatility stresses them out. Some retirees stay partially in the fast lane because they're comfortable with the ups and downs. Risk appetite is personal. It's emotional. And it changes over time. Not just because you get older, but because your life, your goals, and your tolerance shift. And just like driving, you can change lanes when you need to. If the fast lane starts feeling too stressful, you can move to the smart lane. If the steady lane feels too slow for your goals, you can move left when the conditions are right. Financial freedom is not about staying in one lane forever. It's about traveling in the lane that lets you sleep well at night while still making steady progress toward your destination. On this slide, we zoom out and look at the financial world through a simple idea. Every dollar you earn can only go to one of three places, or three lanes on our highway. You can spend it, you can save it, or you can invest it. That's it. Those three choices capture everything you can possibly do with money. And as long as you're balanced across them, you're touching every part of the system where money naturally flows. Now, once money enters these lanes, it doesn't just sit still. When you invest, that money becomes part of the stock market. Companies using your capital to grow. When you save, your deposits sit in banks, and banks turn around and buy government bonds. And when you spend, that money either goes toward productive assets, feeding back into the companies that make the things you buy, or toward what we call hoarding assets, things like gold that hold value simply because they're scarce and widely believed to be valuable. So these basic money lanes eventually transform into four major investment lanes: stocks, bonds, gold, and the US dollar. Why the dollar? Because in the US, almost every asset you interact with is priced in dollars. It acts as the anchor for the whole system. These four lanes each play a role. Stocks are the growth engine. Bonds are the stability lane. Gold is the crisis hedge when uncertainty rises. And the US dollar is the emergency lane investors rush into when things get rough. But how does money decide which lane to move into at any moment? That depends on the economic weather. A combination of growth and inflation that creates four different regimes. When growth is strong and inflation is low, stocks shine. When growth is strong but inflation climbs, gold and commodities start leading. When growth is weak and inflation stays high, stagflation, gold and the dollar take over. And when growth is weak and inflation is low, bonds become the safe haven. Just like drivers on a highway, money shifts lanes depending on which one feels safest or most rewarding under the current conditions. Now here's the powerful part. You don't have to predict the economic weather to benefit from this system. A simple diversified portfolio, one that holds stocks, bonds, gold, and the dollar, has historically outperformed the S&P 500, and with far smaller drawdowns. In other words, just owning all four lanes in the right proportions can beat relying only on the fast lane. And that brings us to the final idea on this slide. If modern cars can sense traffic, weather, and road conditions and automatically change lanes for the safest and fastest route, then your portfolio can do the same thing. That's exactly what Darwin is built to do. Darwin doesn't try to guess the future. It simply reads the environment and adjusts your allocations across the four lanes. When growth is strong, it leans into stocks. When inflation rises, it shifts toward gold or the dollar. When growth slows, it increases bonds. By making these lane changes automatically and without emotion, Darwin keeps your journey smoother and more efficient, just like a self-driving car guiding you safely toward your financial destination. Let's start with the two do-it-yourself portfolios on this slide. Both use the same four lanes: stocks, bonds, gold, and the US dollar, and rebalance on a fixed quarterly schedule. One leans more towards stocks, while the other is equally weighted. Even this simple diversification improves outcomes versus the S&P 500 by reducing volatility and drawdowns. Just spreading risk across lanes already makes the ride smoother. Now look at the Darwin optimized portfolio. Darwin uses the same lanes, but instead of fixed allocations, it adjusts exposure as conditions change. When growth is strong, it leans into stocks. When inflation rises, it shifts toward gold or the dollar. When growth slows, it increases bonds. The result isn't aggressive timing, it's better positioning. That's why Darwin delivers a higher return for each unit of risk taken. Drawdowns are smaller, recoveries are faster, and the overall path is easier to stay invested through. In short, diversification helps. Rebalancing helps more, but actively navigating the lanes with discipline is what improves efficiency. And that's the advantage Darwin is designed to deliver. Now that we've talked about the four major lanes of investing, let's move to the bigger picture of how to actually navigate them. Because winning in the market isn't just about picking the right lane once. It's about staying flexible, adapting to conditions, and using different tools for different parts of the journey. And that's what this slide is all about. The first part is asset diversification, choosing the right lane. Your capital is spread across stocks, bonds, gold, and the US dollar, so no single lane controls your entire journey. When one lane slows down, another lane often speeds up. This is the foundation of winning by not losing, because it keeps your portfolio from being trapped behind traffic in just one direction. The second part is time diversification, which is like choosing different types of vehicles to handle different road conditions. Some strategies behave like motorbikes, fast, agile, and able to navigate tight turns. These are short-term or swing trading approaches. Some strategies behave like minivans, steady, reliable, and adaptable. These are your monthly rebalancing systems. And some are more like trailer trucks, slow, powerful, and built for the long haul. These represent fundamental long-term investing. By mixing these vehicles, your portfolio can handle both smooth highways and unpredictable terrain. The third part is strategy diversification, which is about trusting the right drivers. Instead of relying on one single style of investing, your capital is allocated across multiple expert strategies, each with its own strengths, perspectives, and decision-making processes. Think of it as having a skilled driving team where each driver steps in when their expertise is needed most. Now, here's where everything comes together. Markets are like weather, sometimes sunny, sometimes stormy, sometimes unpredictable. And just like a good driver adapts to the weather, your investment strategy should adapt too. This is where Darwin comes in. Darwin reads the economic weather, your personal risk appetite, and the behavior of each strategy. Then, just like a smart GPS, it adjusts allocations dynamically, easing into safer lanes when conditions get rough, and moving into faster lanes when the road opens up. Now that we've seen how diversification works across assets, time, and strategies, this slide shows what happens when all three are brought together in a single optimized portfolio. What you're looking at here is a Darwin-optimized growth portfolio. It uses the same building blocks we've discussed: multiple asset lanes, multiple time horizons, and multiple strategies. But instead of treating them independently, Darwin continuously blends and adjusts them based on changing conditions. The result is a portfolio that doesn't just grow faster, but does so with far less stress along the way. You can see that in the numbers at the top. Returns are higher, volatility is lower, drawdowns are dramatically smaller, and recoveries are much faster compared to the S&P 500. The chart below tells the same story visually. Both portfolios move higher over time, but the Darwin-optimized portfolio experiences much shallower declines during market stress. That smoother path matters because it increases the likelihood that investors stay invested through full market cycles. This is the practical outcome of dynamic diversification. By adjusting exposure across lanes, timeframes, and strategies, instead of locking into static allocations, Darwin improves the return earned for each unit of risk taken. In other words, this is what winning by not losing looks like when all the pieces work together. Now let's talk about something that affects every investor, whether they realize it or not: bias. Hidden biases in your portfolio can quietly sabotage your long-term results, and this slide shows exactly how these biases show up. The first is survivor bias. It's the tendency to only look at today's winners and forget about all the companies that didn't survive long enough to make the list. When you build a portfolio by only looking at the winners, companies like Apple, Google, or Microsoft, you ignore the giants that once looked just as unstoppable, like Sears or Kodak. The past has far more failures than successes, but our minds only remember the successes. That creates a distorted picture. The second bias is curve fitting. Building a portfolio that fits the past perfectly but falls apart when the future looks even slightly different. The classic 60-40 portfolio looked flawless for decades until inflation in 2022 hit both stocks and bonds at the same time, breaking a pattern investors thought was permanent. The third bias is the belief in stable correlations. The idea that stocks and bonds always move opposite each other. In reality, they can fall together, and when they do, the so-called balanced portfolio becomes anything but balanced. Markets evolve, relationships shift, and relying on old assumptions can create fragility. So how do we build a portfolio that avoids these traps? On the right side of the slide, you see two tests that Darwin uses. The first is the blindfolded chimp test. Instead of carefully picking stocks, we let randomness choose them, just like a chimp throwing darts. If Darwin can still create a risk-managed portfolio that beats the market using randomly selected stocks, then we know the model isn't relying on hindsight or lucky stock picking. It proves the strength of Darwin's risk management, not the strength of the stocks themselves. The second tool is the chaos monkey test. Here, historical returns are randomly flipped from positive to negative. In other words, we intentionally scramble the past to see whether the portfolio can survive unpredictable shocks. If a strategy still holds up when the data is distorted, it shows that the portfolio is built for resilience, not perfection. These tools help us shift from a mindset of prediction, trying to guess what comes next, to a mindset of preparation. Because a portfolio doesn't need to predict the future to succeed, it just needs to be ready for whatever the future throws at it. And that's the ultimate goal. A portfolio that stays strong not because it has perfect foresight, but because it's built to withstand surprises. On this slide, we get into one of the biggest challenges in investing. Not the market, but our own emotions. Fear, greed, and ego shape more investment decisions than data ever does. And understanding this is the first step toward becoming a more resilient investor. Let's start with the myth of the perfect portfolio. Everyone dreams of a strategy that grows faster than the S&P 500, avoids every downturn, and never loses money. Let us talk about this dream investment. Something that looks flawless with nearly 20% annual returns and zero drawdowns. But here's the surprising truth. Even that so-called perfect portfolio still loses to the market almost half the time when you zoom into monthly results. It shows a record of 126 wins and 123 losses, essentially a coin toss. That's what you're seeing in the left panel of the slide. Short-term performance is noisy. It's messy. It feels random. And because investors experience the market in real time, day by day, month by month, the emotional swings hit hard. Fear says, the market's dropping, get out now. Greed says, the market's rallying, go all in. Ego says, I should be beating the S&P every month. But the slide shows something powerful on the right. Time changes the story. When you move from monthly results to quarterly, the win-loss ratio improves, from 126 to 123 on a monthly basis, to 44 wins and 39 losses quarterly, to 13 wins and 7 losses on a yearly basis. As the time frame expands, noise fades and the signal emerges. And this leads to the most important message on the slide. The compass at the bottom right. Patience is the real alpha. The advisor's true job isn't to beat the S&P 500 every quarter. It's to keep clients invested, grounded, and focused on the long-term path, not the monthly noise. Short-term performance will always feel like a roller coaster. Long-term performance rewards the investor who stays in the seat. Your portfolio doesn't need to win every month. It just needs to stay aligned with your goals, your risk appetite, and a strategy you can stick with, even when emotions try to push you off course. Because at the end of the day, discipline is what compounds. Patience is what compounds. And patience, more than anything else, is the real alpha. On this slide, we look at one of the biggest challenges in investing, the gap between what looks good in theory and what we can actually stick with in real life. On paper, the efficient frontier shows the perfect mix of risk and return. It assumes investors are rational, calm, and willing to ride out any amount of volatility. But real investors don't behave like math models. We all have emotional limits, a point where fear overrides logic. And for most people, that breaking point happens when their portfolio drops around 20 to 25%. Once we cross that line, emotions take over. That's how the behavior gap emerges. The difference between what the market earns and what the average investor earns. Investors panic during crashes, sell at the worst possible time, and miss the rebound. Even long-term portfolios lose to the market nearly half the time in the short run, and that short-term noise is exactly what triggers fear, greed, and ego-driven decisions. This is why the emotional comfort gauge on the right is so important. Knowing your breaking point helps you avoid the mistakes that cost real money. If a portfolio is too aggressive for your emotional risk tolerance and you won't stay invested, you'll abandon the plan in the storm, and the damage becomes permanent. The solution is simple. Align your portfolio with your psychology. The best portfolio isn't the one with the highest return on paper. It's the one you can hold through good markets and bad. When you stay invested, the long-term results take care of themselves. This presentation and its visuals were created to help financial advisors educate clients and set clear expectations about investing. You're welcome to adapt and use any of the materials. If you'd like a copy of the slides, just reach out to us by email.